Hey traders, GJ here. Welcome to Forex Success. Let me ask you a couple of questions. Are you being consistently successful at your Forex trading? Are you able to draw down every quarter or every month a bit of extra pocket money? If the answer is yes, then maybe you don't need to watch this video any further. If the answer is no, then stick around, because it is very simple to have a trading strategy that works, apply really good discipline, and be successful at trading Forex. You can actually do it. So before we go on, let's just quickly click on what I see as the key components of successful Forex trading. Money management. If you haven't got money management, you're always going to fail. Money management means that you are disciplined enough to take small losses and have your winners bigger. Secondly, you need a strategy that works, and there are lots out there. You've got to go and find a strategy that works for you, fine-tune it and make it your own. Don't pay big money for all these fancy strategies that are going to make promises of getting your money back within a month if you spend $1,000 or $5,000 for a lifelong membership. Blah blah blah. Forget it. Stay away from that. Find out what different strategies are out there. Decide what time frame you're going to work. Here at Forex Success, we trade everything around the daily candle change. The next key factor is trade in the direction of the trend. It's a well-known fact that pairs only trend maybe 30% of the time in a 12-month period, maybe a little bit more for some pairs. But here's the deal. If you always only trade in the direction of the trend, especially the daily trend or the weekly trend, but especially the daily trend, you have a higher chance of being consistently successful. The next one is to understand support and resistance. Now, support and resistance is subjective. When you have trend lines, for example, some traders will do it a certain way and others will say, no, you've got to do it this way. It's not relevant. The problem with trend lines is they're forever moving. Horizontal support and resistance areas are far more reliable to trade with as a foundation to the strategy that you've chosen to trade Forex with. And we'll get into that, and I'll give you a few examples in just a few minutes. You have to stay disciplined. You have to stay disciplined. Simple but complex. You can't be tempted to adjust your stop losses. You've got to cut your losses so they're small, and you've got to take your wins when you think they're there to take. And you must stay disciplined. In order to stay disciplined, you need to stay accountable. If you're married, stay accountable to your spouse. If you have another trader that you know that is successful and you know that they're not pulling the wool over your eyes, make yourself accountable to a friend. Anyway, but you've got to stay disciplined. And lastly, stay away from unhelpful noise or unhelpful stuff. You get a lot of noise out there with traders trying to sell you their products, their strategies, trying to offer you help and teach you how to plan and plan your trades and win your trades. And you can pay a lot of money and you can spend a lot of time spending lots of money and still not being successful. You don't need to do all of that stuff. Most people that try to sell you their wares aren't actually successful. Now, there are some genuine people out there, but you know, when I see this trading package for $10,000 lifetime warranty, or $5,000, or this special strategy that has a 60% winning rate, well, it's a whole lot of BS. Don't listen to it. It may have a 60% winning rate, but it'll only be for a season, and as soon as market conditions turn around and change again, all that goes out the window. take responsibility. Stay away from trading groups that try to encourage each other, because they're usually full of retail traders that aren't succeeding. Right, let's get to the charts. Okay, we just happen to have gold up, and I've been in gold since it bottomed off here around the 1623. And we saw the highs back in March 22. They were really, really great, and a lot of money was made coming up here. And then everybody was talking about, oh, it's going high, but it didn't. It came off. And you can see real key areas here of support and resistance. You can just, it's easy to point out. So when this came off the top, we didn't know how far that was going to come back. If you used Fibonacci's, it could have been a retracement number. It could have been, but I just backed right off. I didn't know whether that was going to fall, and we were in the middle of a whole lot of volatile stuff. And so as it went along, I was waiting for a break again above 2000. I wasn't going to touch it. Gold can burn you. So there's the 2000 mark, and it did poke its head up there, but you just stay out of it. This is where traders get beaten up. If you want to trade it on smaller time frames, that's fine. Well, I don't have to trade. So this formed a real support area there, and I just waited, and that's where I got in to come down. And I just kept trading in the direction of the trend. Now, once we got down here, there was talk that it was going to go as low as 1600, but it was obvious, you get stopped out, or you take your profit, because that's a lot of money. This is where you make your money, in these long trends, and you can get stopped out on the way, but you just wait until you can get in. That was a great move, and then it pulled back. And what I do is I pull my stop losses into break even as soon as I can. So for an example, there would be my pending order under there, and my stop loss is going to be up there. And if this is truly going to get going, I'm going to make some money. And as it gets going, you just adjust your stop loss all the way down. And then once it gets down here, you might have had it there. You could have pulled it up and had it there, because those are daily candles. You get stopped out, and then you just wait. And you can see in here again, this was a major, it's in purple, so it was a major monthly thing, the 1800 mark, and in order for it to break out of the trend, it's got to take out this area here. It has to. And it didn't, and it just went for weeks, about four weeks or so. And then it came back down and it broke out, and I had a pending order in here which didn't get taken in, and it went back in, and then you've got another couple of weeks and it breaks again, pending order in, and away you go again. It's just real simple. And of course you pull your stop losses up as you go. So that beautiful candle there, you get down there, you can pull your stop loss up into here now. And then at the end of that candle, you can pull it down to there. And indecision, then it has another crack. So you pull at the end of this day, you're pulling your stop loss down into here. And then you wait. And you can see that it was pulling back after that day. Look at it. And then we have indecision, so you don't do anything. And what you want to see, if you're going to get another break and it's going to go lower, it has to take out this area here. It's just not rocket science. It's real dead easy. And you get stopped out, and then look, it went up again, the 1800, as long as it stayed at 1800 underneath, it was likely to continue down again. And so there's a key resistance area, and then you could trade this. You go to 4-hour hourly chart, but all it is a pullback at this stage. But you don't know that when that starts to break out of this key resistance area. So you just leave it alone, and it's weeks before you get another chance, and that's fine. There'll be other trades around on other pairs. And so you wait, and when it breaks back down below, what you're looking for is a break of this area of support in here. And you just put a pending order in, and you can pop your stop loss up in here. You could have probably even taken that, but because of this little shelf in here, you play safe. And you just wait, and you have to wait. There you are, you're taking in 1, 2, and then it goes back, and am I going to lose? Am I going to lose? When you get up and you see this candle here, you can go, well, you can pull it down, or you can just stay there. If that's the amount of money you've decided you can lose, you just stay there. And then you get this, and this is a good sign because we're in the direction of the trend. We get an engulfing candle. You pull this down to break even, and Bob's your uncle. Look at this. And you just work your way down again. You might have had an opportunity to add here because it broke a key area. And so that's how I trade it. And you just choose the way you want to trade it. And so the trade that I'm holding at the moment, I've had opportunity to add on the way up, and I've been stopped out and taken profit, and I took profit at the end of the trading week, but I'm sitting here with this trade. All my other gold trades are off. Okay, and just a quick look before we pack up. Euro CAD a wee while ago was a beautiful trade. Traded it all the way up as soon as I saw the break of this area here. I was in. This is where you make your money. And I was looking to add at every opportunity that I could. Made heaps of money. This is where you make your money. Trying to trade this messy stuff in here, this is where traders get beaten up. So that's my methodology. It's simple. It's not hard. And when the market opens this week, I'm going to do a week ahead, or look at the week ahead video, give you an idea of what I'm looking at, and you'll see where I've got my support and resistance areas in. It takes me less than 10 minutes to see if there are any potential trades for the day. If you like this video, give it a thumbs up. Refrain from rude and crude comments. I'll just delete you. Make sure you can't put any comments up. Don't mind constructive criticism and debate. It's all good. It's the way you learn. But hang around. It doesn't cost you anything. I just want to pay it forward. So I'll leave you with that, and we'll see you at the market open tomorrow. Cheers.